Welcome back. Here with money. On our mind this week is learning the core of good money management, which is the saving habits that you actually need to avoid. Pankaj Mathpal of Optima Money Managers is our expert, and also with us this week are two of our investors, Satish Rakari and Deepak Joshi. Okay, so we've got the basics of saving right and spending right with us. What about investing right? You know, one of the big fallacies that a lot of people have is that, the interest rate which is spelled out on loans is what they go for. A lot of people, you'd be surprised, don't actually end up negotiating on that rate. So what is your advice for people like that?
Sometimes bank also, for the salaried individual, they give a better rate, but for the business people or who do not have a regular income, the rate is higher. So for that also it matters. If you negotiate with the bank, you may end up getting a better price. So I agree with you, but for this, people should understand that first thing, rate of interest differs from one bank to another bank. Second thing, within the bank also they have different packages. So to one borrower they will offer different rate, to another one they will offer different rate, and it depends on your credit history also, and your regular income and other things. But still you should have always scope for negotiation, and you should do shopping for that.
I changed the car in the third year, and I again go for a loan. So it's a good option or not a good option?
Taking loan is good only when you think, one thing, that you don't have money, so there is no choice. Second thing, you know that you have money, but it is earning more than what you pay towards interest on that loan. So if you have money, for example, that is lying in the bank fixed deposit earning 8%, and you are paying 11% on your loan, so that cannot be a good idea.
Okay.
So you have to decide whether the money can earn more than the interest or no. So in your case, as you said, you are entrepreneur. For example, you need money for your day-to-day business, and you want to keep sufficient money with you, and otherwise maybe that for your business you will have to borrow, which will be rather costlier than this car loan. So that can be one idea. Maybe that because of that you are taking loan. But again, if you are taking loan and you have money parked in fixed deposit more than you need, you must have done some planning for your business, and other than that, if the money is lying there, then I'll say that first you should use your own money for buying anything, whether car or any other item, and then you should go for loan.
Okay, so as far as possible, you should go for down payment option.
Of course, if you have money. But in some cases, as I said, in his case, because for all business people, they need more liquid than the other salaried individuals. So in that case, if he has fixed deposit, but that he has kept for his business purpose only, then I'll say that you can take loan.
Okay, so you should basically see the opportunity cost of that money, which is fetching you a better return. Yes.
I have taken a loan for the tenure of 20 years. I have some money in my bank account which I want to repay. The amount is 50 lakhs, and I want to repay it now. So will it be the better option to repay it now or continue with the loan?
Okay, so this is actually a tricky question, because we actually end up getting a lot of tax benefits on home loans. So should you foreclose your home loans, or should you continue with those tax benefits?
See, two things are very, very important. One is, as Sumira said, that tax benefit, because that is something which you get because Section 24 benefit that you get only on home loan, that you cannot compensate with your investment in other instruments. Second thing is rate of interest, because home loans are comparatively cheaper. So suppose you are paying 9.5% or something like that on your home loan, and you feel that by investing that money you can get more interest. So I'll say that continue with your home loan and invest your money in such, but again, it is very important when you invest your money, it should get good returns. Sometime, again, as I was explaining to Satish, what happens that people invest that money in fixed deposit. Suppose you are paying 9.5% or 10% on home loan, and you get 8% on bank fixed deposit, then that may not be a good idea. But yes, as we are seeing that loan interest is coming down, and we are also finding good opportunity in market to get returns on your money. As of now, I will suggest you that whatever money you have, instead of repaying your home loan, you invest that money with good planning, with good research, and you'll be able to make good returns. And of course, because you have to pay tax also, so you get tax benefit when you pay interest on that home loan?
Normally I invest my money in PFF and FDs only. So I should continue with that, or should I invest in mutual funds?
Deepak, you have asked very valid question. You are very young. Most important is asset allocation. In your portfolio, you must have some debt instruments. At the same time, you should also have equity, because equity gives you opportunity for good growth, and this fixed interest bearing instrument gives you stability to your portfolio. So it is important that you should have both, but as you are young, you will have long term goal as well, and in long term we have always seen that equity outperform other asset classes. So you must have investment in equity, first thing. Second thing, as far as mutual funds are concerned, because there are different types of mutual fund, we have equity mutual fund, we have debt funds, we also have hybrid fund which invest in equity as well as in debt. So for you, I will suggest you should avoid investing in fixed deposit, etc., except only when you keep money for your contingency, some short term fixed deposit where you think that in any emergency you can withdraw your amount. Otherwise, for most of other goals, you should invest in mutual funds. So in your portfolio, you should have different kinds of mutual fund. First, you set your goal. That is also important. Without setting your goal, you don't know that how long you will remain invested for that. And then suppose it happens, people think that they will invest for 15 years and they need money after 6 months. Then it may be a wrong strategy, because you are investing in equity, considering you are investing for long term, and you withdraw after 6 months. That can be riskier also sometimes, because equity markets are volatile. So in short, I will say, first thing, set your goal, your short term goal, medium term goal and long term goal. Then for your contingency, etc., you should keep your money in fixed deposit as you said, but for long term, especially for retirement and your child education, your 70-80% allocation should only be in equity. And equity mutual fund is a better option for you rather than going in direct market, because you are a new investor. As you said, you don't invest. So I will not suggest you to go directly in the market, but through equity mutual fund, you make your portfolio.
Okay. I actually have an easier way also to make you understand. I heard a fabulous analogy over the radio the other day which said that your portfolio allocation is actually like a Gujarati thali, right? It's just that some bowls are bigger than the others, but you must eat everything that's there on your plate.
Very good.
Good. Basically, I have a kid, aged 4. She has just started going to school. Isha has just started going to school. I have just started investing. So what amount is a good amount for investment?
Satish, most important is that what is the correct amount that you should know, because you invest, but you will also not know whether you're going in the right direction or no. It may happen that when you really need money at 17, 18 years of age, or maybe for higher education at the age of 21, 22, then you realize that money is not sufficient and there is no option that time to reverse your exercise. So better right now what you do, first thing, that whatever you have in your mind, what you want to make your child, because as such nobody knows that what your child will become, but every parent has some kind of planning. So as of now, whatever you are thinking that your child should become engineer, doctor, whatever. So considering today's cost and considering inflation, you calculate future cost. That if you need 10 lakh rupees for that kind of education today, considering 10% inflation in education, how much you will need when your child will come to that age. So considering that you know that my target is to accumulate 50 lakh rupees, 30 lakh rupees, whatever, and then do the calculation that at a certain percent return, say suppose you are investing in equity and you expect 12%. So at 12% to achieve 50 lakh rupees, how much I have to invest every month, and then start investing. Because otherwise it may happen that when your child is 21 years, then you don't know that whether the amount is less and what to do now. But right now, if you know that you have to accumulate 25 lakh after 20 years, then after 5 years how much it should be, after 10 years how much should be, and if you think that the amount is not sufficient, you may increase your investment amount, but that can only happen when you know what is your goal and how much time is left to achieve that goal.
Yeah, so basically the lack of goals would be one of the biggest mistakes that you could possibly be making.
Correct.
All right, on that note, Pankaj, thanks very much for advising all our viewers, and of course Satish and Deepak, thanks very much for joining in and for sharing your experience with us. I hope this has been helpful for both of you.
Yes, it was great. Yes, surely.
Thanks a lot. Thanks very much. Pankaj, thanks again. All right, let's do a quick break on that note. When we come back, it'll be time for our tip of the week. Stay tuned to Money, Money, Money.